Thank you for tuning in to episode 274 of This Week in Real Estate. We are the T-Wire podcast, broadcast live Wednesday, May 15th, 2024. Is the housing market dead? Oh no. This episode was brought to you by viewers and listeners just like you guys. Without you, we wouldn't be a member of the YouTube Partner Program. So we are there now. We're broadcasting live on YouTube, Facebook, Instagram, LinkedIn. We're broadcasting everywhere you can broadcast. And if you want to add your voice to the show, all you got to do is comment. If you're commenting on YouTube, I can display your comment just like Olivier did. He said first, this has been a crazy week so far. And he beat the infamous Matt LaMarche, who always tries to be first with a comment. Olivier said, what can I say? Southern people aren't too quick. Ooh, boy. You know, I'm about to invade Canada next week, so be careful, sir. If you are on LinkedIn, you can also comment. I can display your comment on LinkedIn and Facebook. If you're on Instagram, I could just give you a shout out. There's no way for me to display your comment, so I just give you a shout out. And if you're at Clubhouse, you can actually raise your hand, come up on stage. One of the moderators will check first to make sure you actually have a profile filled out. And if you do, you can add your voice to the show. I think we are the only live podcast that does it like this. So thanks everybody for tuning in. We're going to jump right into it. But before we do, I did want to mention that we have I put a couple of links in the in the description. One is the link to the show, obviously. So if you're checking this out on Instagram, you could click the link in the show and then you can see it on YouTube. Our goal is to get to 10,000 subscribers. We're at 7,600 subscribers now. So we are almost there. Tim Knows Loans. He chimes in. Ray. What's up, Tim? Thanks for joining. But we are in the show is live. We out here, says Matt LaMarche on Instagram. Matt is always going for what is it going to be called now if you tune in on every possible median all at the same time? Jennifer.
I think we call that LaMarching it.
LaMarching it, yes. Yeah. We did have some kind of weird contusion of words that the letters that we were going for, but this works. Jennifer, what's up? Jennifer Mebbury, realtor from Portland, says hi. And I just got distracted. Okay, yeah. Okay, so we're also broadcasting live on the T-Wire pod. All right, so I also put in, if you go to Rayzorback, RAYZORBACK on Instagram, you'll see a link to the contributor chat as well in my stories. So if you want to be a part of the discussion and get over to the contributor chat, it's on WhatsApp now. We moved it from Messenger so more people can get in it. So jump in there. Feel free to submit articles, talk about what's happening. And we have some discussions there. Hopefully we'll be ramping up those discussions even more. But Move Me to Boston says, awesome. What's up? Matt LaMarche fan club in the house. Oh, Matt. Jennifer is in your Matt LaMarche fan club. So for those of you who don't know, there is a Matt LaMarche fan club in Clubhouse. You guys go look it up and be sure to join. The big rule there is that you can never make Matt LaMarche moderator in that club. So I'm sure you join the Matt LaMarche fan club.
I think the frequency of rooms now is down to one every 3 years. Yeah,
I mean, it's still most in a lot of houses over there. So Jennifer says on Instagram, she goes, Malarsh. The Eric Rodriguez, he says hi from SoCal. Yeah, drop in the comments where you guys are watching from. And if you're on YouTube too, that goes on the replay. So Dell Schaefer says, what up, Ray? Dell in Charleston, South Carolina here. What's up, Dell? Olivier said you're invading the West Coast like invading Maine. Is Banff on the West Coast? I have no idea where it is, Olivier. I just know I'm nervous as heck to leave the country now because I got a passport thing, so I got that, and I'm like, what other stuff do I need? So I got to figure this out. If all else fails, I'll just jump the fence. Adam Johnson, he's in Superior, Wisconsin, Duluth, Minnesota. What's up? Rick Beal, what's up, Rick? He's in the contributor chat contributing. He said watching from Maine, where Olivier apparently wants to invade. All right, well, let's jump into the news. Last week, if you recall, I feel like last time, the episode episodic series. Last time on This Week in Real Estate, there was an emergency injunction that was filed by Banton to halt the settlements of Keller Williams, Anywhere, and Remax. And the reason is because the Batten folks were like, no, don't include us in that. We want our own day. However, that was approved. So our first article comes to us from, no audio. I don't want to play any. Okay, there you go. So our first article comes to us from Inman, and it is talking about the approval. Judge approves Keller Williams Anywhere Remax settlements. A ruling by Judge Stephen Arbeau on Thursday resolves the antitrust claims in the Sitzer, Burnett, Mole, and Nautilus cases. However, it won't quash other existing suits from buyers. Despite last-minute attempt to block them, nationwide settlements, Keller Williams Anywhere and Remax reached to resolve antitrust claims against them have received the final approval in court. So this was a big misnomer that I saw last week too, which is one of the reasons why I wanted to address it at the top of the show, because everyone was like, hey, the NAR settlement is over. No. These are just the individual settlements for these brokerages that settled instead of going to court with NAR. So the NAR settlement has not yet settled. The various remarks, Remax says, we thank the court for the careful consideration and decision, which is kind of political. That's what you always say whenever they reach a verdict and approve your settlement. Since entering the settlement in October of 2023, Remax has been committed to obtaining final approval and providing releases for all U.S. Remax broker-owner affiliates. We're thrilled to be moving forward, maintaining the focus on supporting Remax affiliates. They had a press release about it. Anywhere CEO said it's a significant milestone in our path to put the claims behind us and to begin to implement agreed upon changes and move forward with their affiliated agents and franchises. Anywhere stressed that the deal is not an admission of liability on the company's part. And then, let's see, I think that's all in this article. So, and then it kind of rehashes what we already talked about. So that is just the Anywhere, Remax, and Keller Williams lawsuits. However, the judge did indicate support for the proposed NAR settlement. So the judge last week gave the green light. This came out this week to real estate franchisors nationwide. Antitrust settlements also heaped praise on a more consequential deal, the proposed settlement between the home seller plaintiffs and the National Association of Realtors. So I was real interested in what exactly, like how do people make a claim? What are people going to get? It adds up the settlements. It said it's heading towards $1 billion collectively altogether with Remax, Keller Williams, Anywhere settlements. These settlements provided a total settlement fund of over $600 million. With the other settlements announced to bring the total to $900 million. So we're almost at $1 billion now. The NAR settlement provides opportunities for various multiple listing services and brokerages to opt in to the settlement, which may provide further financial compensation to the settlement class. So they talked about the NAR practice changes. This is what the judge was saying, why he thinks this is a good idea. The judge thinks it will provide significant savings to sellers, which just makes no sense. I mean, it drives me crazy that folks are saying that. It just makes me no sense.
You gotta be kidding me, right?
No, that's what he said.
We were hoping for like educated minds to read a couple of pages or maybe an interview. Are you kidding me?
Yeah,
so it wouldn't have upheld on appeal if they pushed forward.
Correct. Yeah, I think that's what we're seeing now, and it would have essentially been if they didn't settle. Rick says these funds are all going to attorney's fees. A large portion of them are. There's nearly 200 claims. There's nearly 200,000 claims so far. More than 95% of potential settlement class members received direct notice of settlements. As of May 2nd, nearly 200,000 claims have been made, but only a dozen objections to the deals were filed. This is only the beginning of claims. because the claim period extends until May 9th, 2025. The extended claims period is valuable because it between blah blah. Okay, let me get to the part which people, how much they get. The court says it's not going to be perfect. There's a Pult objection that he ruled on too. He said they plan to distribute claims that the home. Y'all remember the home builder? If if you're a real fan of the show, you remember that we also covered that one. But the home builder was demanding was not needed for the final settlement approval, so he tossed that one. For class members who did not mail or call or inquire about allocation, class counsel explained that the class members are unlikely to receive the full value of their claims, but that settlement proceeds will be distributed equally. So what do people get who are actually the plaintiffs, who lend their name? So named plaintiffs and their attorneys will get paid. The plaintiffs who lent their names to the commission suits will receive either $15,000 for their service or $25,000 if they appeared at the Sitzer Burnett trial. Where's the class's counsel time and labor invested? Substantial. They're required to expend $12.9 million of their own money towards the litigation. I thought that was interesting. They had a total of how much it cost them to litigate, and it cost them $12.9 million in costs. So they're going after the reimbursement of those fees. And where's how much I guess we've been throwing around the word 30%, but I'm not sure what the exact number was. So if you did not show up in court, the settlement classes, so to resolve the claims against Anywhere Remax, the settlement classes are all persons who sold a home that was listed on the multiple listing service anywhere in the United States where a commission was paid to any brokerage in connection with the sale of a home with the following date ranges. March 6th, 2015, April 29th, 2014, to the date of notice is MLS PIN, December 17th, 2016, or all other MLSs, February 1st, 2020. To resolve claims against Keller Williams, the settlement class is the same except the dates for all other MLSs category October 31st, 2019. Did anyone know how they came up with the end dates on those, by the way? Or the start dates? Like, why are these? It seems like that would be significant. You know, it's like, how do you determine what day? I guess it's probably a statute of limitations or something. But I was wondering if there was something else that caused that. So for a lot of places around the country, this is, you see people talk about the added transparency. And you also see agents saying, like, how is this transparent? Now commissions are going to be hidden. So the reason for that confusion is that a lot of places around the country, they didn't have representation spelled out for a buyer. So whenever someone was purchasing a home, they didn't have to sign a document necessarily. And the agent they used to go find a home would get paid by the listing agent or the seller. And that's just how it worked. There was no necessarily any kind of documentation defining that relationship between the buyer agent and the buyer. And now in those places, you will have a defined relationship between the buyer agent and the buyer. We've had this. I mean, I started real estate in 2007, and I've always had that. We've always had a fee structure that we explained. Here's how people get paid. Here's how people make money. Here's how real estate agents make money. Here's who pays who. Here's what you would be responsible for if they didn't pay it. And so in our state, for all we could figure out, I mean, it's going to be very little change. The biggest change in our state is that it's going to require a phone call now whenever we show properties to say, hey, what is the seller going to cover? Which is kind of weird that you have to make that phone call every time. It seems like if you just put that out there, that it would be easier. Like, how is that different than everyone calling and figuring out what sellers are going to pay towards the buyer agency compensation? I don't understand how that's different, because it's not like they're not telling you. They will tell you, but it's just not public. It's not publicized anywhere. So what's up, Matt? I heard you unmute.
Yeah, well, I'm curious too because at least in the past I could have saved the MLS printout for that particular listing and said, hey, look, you were offering a percentage point here, or whatever percentage point for later, and that way when we're in an attorney state here in Georgia, so the instructions to the closing attorney say a different thing, I can come back and say, well, no, wait a minute. There's a little discrepancy here. Meanwhile, we're counting on all these listing agents to be honest, forthright, work with integrity to tell everyone the same percentage. Is that also maybe in the cards?
Yeah, that's apparently the agent is supposed to be revealing the same number to everyone. How do you verify that? I have no idea. So we'll see what happens around the country. That the NAR has been kind of cagey. Is that the right term? But they can't they can't say, hey guys, y'all should do it like this, because that's what that's what they just got in trouble for. So they essentially have to say, no, you guys figure it out. And we're confident that you'll figure it out because enterprising people in a capitalistic society. But it seems like there is opportunity for fraud, abuse, fair housing, and all that will just have to be worked out in the new system, I think.
So maybe a new best practice then would be, instead of calling, to maybe get it in text form.
Text, yeah. I'm going to get it. I mean, I'm always going to try to get it in writing, and I would probably submit an email saying, hey, this is to verify per our conversation, per my last email. All right. So that's where we are with that one. It looks like that's going to get approval, especially since the Anywhere Remax and Keller Williams settlements got approval. It seems like it's gonna keep going that direction. I did see some changing dates on implementations and everything, but my understanding is that in July, everything will be taken off the MLS, and in August, everyone will have to use representation agreements. But somebody said some of those changes may be pushed to November. I just haven't seen anything official on that yet. And I don't think we will know until it's actually settled. The dates just kind of keep moving. All right. So in other news, we did have some Compass expansion. And you remember a couple of years ago, it seemed like Compass expansion was on the docket every single week. Well, recently, they just took over a 1,500 agent Tennessee brokerage. And it's called Parks. So 49-year-old Nashville brokerage Parks Real Estate has merged with Compass. Their firm boasts 15 offices nationwide and closed $6.25 billion in sales last year, according to an announcement Monday. Tennessee's top performing real estate brokerage Parks has merged with Compass. Today we have significantly added to our presence in the Southeast, welcoming a top brokerage in Tennessee. Compass CEO founder Robert Refkin said in a writer statement. Oh, wait, I'm sorry. Yeah, I'm sharing the right one. For a second there, I thought I was still sharing Clubhouse. Parks has been in the Metro since 1974. And I think this is the biggest acquisition they've had in quite a while. My understanding from some of the inside info is that the Parks agents will be co-branded, but there's also other parts to Parks that were branded independently. And it doesn't mention in the article, but there's a 200-person group, I guess you could say, team, I guess you would call them now, that they're under the umbrella of Compass, that will still be branding as themselves to make it seem like a local brokerage, but they'll be empowered by Compass, which in my opinion kind of shifts, it kind of signals a shift in the model that Compass is using. If they do that, then they're more like Side or Real Broker. We have the Pro Teams model, but there's also like an indie model where you can partner with Real Brokerage, but kind of keep your indie name, brand, and everything, and Real is powering everything behind you. I'm wondering if this is like a pilot for something more for them. Parks Real Estate, 15,650 agents, closed 9,776 transactions in 2023, $6.25 billion. The Parks Real Estate CEO, Hunter Connolly, said Compass aligns with Parks culture, which values collaboration and fostering agents' entrepreneurial spirit. Quote, we believe that with Compass, we are positioned for sustained success within an evolving industry landscape. Combined, we have more listings, more collaboration with great agents, and industry-leading tools to serve Tennessee. Parks Real Estate is the latest chapter of Compass expanding. So here they go. So that's it for the industry tea. It was kind of a quiet week, actually, as far as the industry goes. I'm curious if they're going to continue. I think Compass. I'll just leave it at this. As I was talking to the insider that tipped me off on this before it happened, it's kind of fun, or right as it happened, and they found out through social media. They were all emailed a video, but it's the same video that went on social media, so that's kind of weird. But anyway, as I was thinking through this, I know Compass has to grow. Without growth, without expansion, then there's nothing on the books to show the increase in revenue, the increase in transactions. And so they're forced into this expansion mindset that they had because that's how they started. But they took a step back for a little while. And instead of doing this severe expansion, if you remember, they really tried to drill down on what they were already doing. And I guess they're done with that because it seems like they are now again focused on expansion. I don't know if they are going to continue to do the to buy agent teams. That's what they were doing for a while. They were buying the agent teams, or they would look to partner with brokerages, and then they'd pick off the top agents. Is what they got in trouble for in the past. So I'm interested to see what happens. I think Compass is a formidable opponent. However, opponent as far as real estate goes. However, their tech, we need to see if the tech pays off and what they say they will do. And I think if they could do that, I think they'll be around for a long time. But they got to get those profits up. Maybe not. I mean, maybe they'll just keep getting investors and people buying the stock and people getting them the rounds of venture capital. But it seems like eventually they have to turn a quarter and become profitable. Adam Johnson said, he's talking about the NAR dates. Some of those dates will be pushed, maybe never. If we could push this thing until after the elections, we might be able to have a more friendly environment. That's an interesting thought. If you push everything until after November into 2025, and then, everyone changes up there. Farden says, hey there. What's up, Farden? All right. So let's dive into the economy. This article is on Redfin. It says that I'm not sharing the article. Please wait. I should play some music. Well, I'm always nervous about playing music because of my copyright strike. So just imagine some Jeopardy music right now. All right. So Redfin says record high monthly payments chill spring selling season, but declining rates could boost activity. So I want to know what's going on in your market. Team Paletta says, why do you feel housing is crashing? Perfect timing on the question, Team Paletta on Instagram. Do I think it's crashing? No. Is it changing? Yes. Why did I put crashing in the headline? So you'd watch. Record high monthly payments chill spring selling season, but declining rates could boost activity. We're in a really weird spot. In my market in particular, what we're seeing is houses are starting to sit on the market longer. I looked at the average days on market of active listings compared to the same time last year, average days on market of active listings, and it's double. And so if we had a listing last year that was sitting for 15 days and sold, we were like, woo, finally, that was getting close. And now it's closer to, 30. We're trending upward in the averages. The averages are much higher. Last year the averages are 30 or 40. Now the average days on market is closer to the 60, 70 in our market. So the median is definitely still different than the average, but we're still seeing an increase in days on market, and we're seeing a decrease in buyers that want to enter the market, mainly because of the discussion around rates and affordability. We're not seeing a meaningful decrease in home prices. We are seeing homes drop price, but the actual selling price of those homes is still over what it was last year. So home prices are still increasing. We're still seeing an appreciation to homes that were purchased last year. It's just not what it was in 2020, 2021. Now we're seeing a much slower rate of appreciation, though home prices are still going up. You just can't get the aspirational sales price that you once could. And this may be echoed around the country, or it might just be my place here in Arkansas. But we have to know what's happening locally in our market, because if you don't, then you can't give the advice that you need to give to your clients. You have to know what's happening nationally so you can start to track the trends and see what's happening, because a lot of people are moving around the country again. So how can you advise them on what to do if you're not keeping your pulse on exactly what's happening? Now, one thing we do know is that there's still not enough inventory to satisfy the full buyer demand if all buyers were in the market. We are seeing fewer buyers come into the market. However, we know that that is a choice based on affordability and not based on the want or desire to buy a home. If they could afford to buy a home, they would be buying a home. So if start to go down, you would see another jump in home prices because the inventory to satisfy the actual demand is not there. So if you're working with a client today and they're worried about rates, in my opinion, give them advice relating to how important it is for them to buy something that they can afford now, right? So buy something so that you can get out of the rental market, which is also going up. Rents are also increasing. So buy something so that you can take advantage of their appreciation. And then either down the road, if rates go down, you can refi, but don't buy a house hoping that rates go down, or don't buy a house needing the rates to go down. You can hope that they go down, but don't buy a house needing those rates to go down in order for you to afford the home. That's a bad decision. But buy a piece of real estate that will go up, so that one day you can either sell it and buy something else you want, or you could potentially refi if rates go down. But the whole marry the house, date the rate, it's still bad advice because it's shallow and doesn't actually address what they need to know. Adam Johnson said, so what you're saying is people are overpricing their houses, so it's not really a decrease in the adjustment to a market value. Yes. So you'll see a huge increase in the number of homes that are listed on the market that are decreasing in price. And the news will say home prices are dropping like crazy. Well, maybe, but they're still higher than if you purchased them last year in a lot of places around the country. Actually, there was the report last year that said in all 50 major metros, home prices have not decreased for the first time in several years. So yes, home prices are still higher than they were last year, but the aspirational sales prices of homes, that's what you're going to see the majority of decreases on. And it's a discussion that we're having with now as we try to find market pricing, because I can look at comps from 6 months ago and we could kind of try to price the home. But a lot of people look at those comps from 6 months to a year ago, and last year before that, we were adding a little to it. And now it's more like what those are. So it is decreasing the rate of increase. Home price gains slow. Adam Johnson said, I'm pushing people towards a 5-year ARM. Mortgages at 6%. Yeah. I'm going to ban that user and delete their comments because it's fun. However, demand at 300K and below. Yeah, so we're still seeing a large amount of demand on the bottom of the market, but they're very sensitive to condition because they have no extra money. Is that what's happening where you are? Team Paletta said, Southern Ontario condos are taking a bit of a beating. I know on the coastal regions, Miami, if some of you are in Miami, Florida, California, you're in the coastal areas, you're having insurance issues. So that's causing an affordability decrease. I also know there are changes in condo laws. Is that for all of Florida, or is that for just the Miami area? I think it's for all of Florida, where they have to basically remodel the condo if it's a certain age. The condo group has to remodel the thing if it's a certain age. So that's also going to increase cost. So there's a lot of things that are increasing cost, not just rates, but rates are a big issue. Another thing that's going to increase to eat into the cost is the cost of living. There was an interesting graphic the other day that I saw people buzzing around on social media. Let me see if I could share this. It's not really a screen. How do I share a window? Yeah. All right. I thought this was interesting. It shows the income a family needs to live comfortably in the U.S. And it's a graph from 178,000 to 301,000. And it's based on 2 working adults with children. Wait a minute. Is it based on 2? So both working adults have to each make? No. It's got to be combined. Yeah. So the highest is Massachusetts with $301,000 needed to live, 2 adults with 2 children. The lowest is Mississippi with $178,000. Adam says household income. Yeah. $178,000 in Mississippi. Arkansas is 181. We're the number 2 lowest. So let's see, who's the second highest? 301 is up there. I don't see anything in the 290s. California's at 277. Colorado's at 265. I'm looking. I don't see anything else close to 300. Like nothing in the 290s, nothing in the 280s. So there you go. The income a family needs. I thought this was. I'll try to throw a link to this somewhere so that you guys can find this. But the data is from Smart Asset, so you could probably just Google this phrase with the word Smart Asset and find this if you guys wanted to share it to your social media. Oh, there's 280. Connecticut. Connecticut has 280. So I guess they're number 2, and then California is number 3. Oh, Hawaii. I forgot about Hawaii down there at 295. Yeah, you need some money to be on the islands. But that seems fair, right?
Yeah, but not as much as good old Massachusetts.
Not as much as. So take your pick, guys. Do you want to live in Massachusetts or Hawaii? It's cheaper for you to live in Hawaii. That's funny.
Yep. Welcome to my state, baby.
Jack, you got to share that on social media and say how many of you guys want to move to Hawaii.
Who wants to be number 2?
Yeah, that's right. I mean, they would have what, $120,000 extra if they moved to Arkansas, Jack. So we could make those referral agreements all day.
All day.
But I think that's what's going to be happening. I mean, as the market continues to change, and as the most desirable places, which apparently is Massachusetts, as the most desirable places on earth increase in the cost it is to live there, I think you're still going to see people moving around the country. And I mean, we saw it happen in the COVID years. We saw people moving because of the pandy and the different rules and regulations and politics and all that. I think we're still going to see some of that, but I think a lot of the moves around the country are going to be based on income. It's going to be based on how much it costs to live there versus, if they could come to Arkansas and get a similar job and maybe it's 10% less on what they would make. However, they can live on half, 50% less. That's a huge change. I mean, they can live like kings here. It's always fun for me to talk to other agents around the country that are doing deals in the 500s and 600s and tell them that is almost luxury. A couple of years ago, it was luxury, but then COVID happened. But that is almost luxury in our market. And then that's like the low end in theirs. It's wild. But I think that's what we're going to continue to see as mortgage demand from home buyers drop, even as interest rates pull back to April lows. This article was on CNBC. Mortgage rates last week dropped to the lowest level since April, but buyers are still struggling to afford today's housing market. As a result, the mortgage demand flat week pace. Total mortgage application volume inched up 0.5% from a week earlier. Applications to refinance, which were most sensitive to weekly rate changes, did increase 5%. Applications for a mortgage to purchase a home fell 2% for the week and were 14% lower than the same week last year. So the drop was driven by a 9% decline in FHA applications. Those are favored by first-time or low-income buyers. What is his title these days? He's the Mortgage Bankers Association chief economist or something like that. Yeah, Joel Kahn, MBA's vice president and deputy chief economist. He said, while the downward move in rates benefit prospective homebuyers, mortgage rates are still much higher than they were a year ago, while for sale inventory remains tight. It's loosening up, though. I think we're all seeing a little more inventory coming on the market, but primarily because buyers are stepping back, not because there's a whole bunch of new builds. Lawyer Up One on Instagram says all of Florida has condo issues. Yeah. So I think you're going to start to see people moving around the country to areas that are more affordable. I mean, if they could get a nice home in Arkansas for $300,000, or they could, a dumpy remodel where they currently are, it kind of makes sense just to move. Down payments are averaging $26,000. That's the highest Q1 level on record. So the median down payment for the first quarter 2024 was $26,000, which is an average of 13.6% down, according to Realtor.com's latest down payment report. Based on its analysis of down payment trends in the national, state, and top 100 metros, down payments have climbed 3 percentage points, roughly $12,000 from the first quarter of 2023. Wow. Median down payment hits Q1 peak, and I've got a nice chart from Realtor.com. The red number is your primary residence average median down payment dollars, and the blue chart is the primary residence average down payment percent. So you can see it's both. It's high on the dollars, which that's interesting. We did see, okay, so y'all remember what's the reason for this inversion here, where you have what did that get up to? $30,000 down payment, but it was only 14% of the average down payment percent. That was at the height of COVID. So you had way more people putting big money down. And so that's an interesting inversion that is happening in the chart as it goes up. So it's still not the highest amount down, but it's one of the highest percentages down recently. Claudia says, Claudia.Karon, Karon, says, in Southeast Florida, now we need certifications and older condos, plus condo now needs to have reserve. Yes, that's what it is. They have a reserve, and home insurance are going up so much. So there's a reserve now for the condo to be able to take care of their maintenance, which it seems like that, it kind of should have been done on their own. They just didn't. And all right, so while the numbers have fallen from the record high set in Q3 2023, down payments are still well above the pre-pandy levels. Buyers put 87.8% more the down payment in Q1 2024 than they did in Q1 2020. Wow, that's almost double. Your down payment almost doubled from 2020 to 2024. It's 4 years. That's a long time, but still. Realtor chief economist Danielle Hale says the current housing market's overall unaffordability has an impact on who's buying homes right now. Given persistently high home prices and elevated mortgage rates, many of today's purchasers are likely either high earners or repeat buyers leveraging existing home equity as a down payment. And this may explain why down payments have dipped but remain relatively high. So they have a list of key takeaways from the report on Brokerage Media. Down payments in Q1 2024 rose an average 13.6. Yeah, we kind of already covered those in the review there. The top U.S. metros where buyers made the largest down payments were all high-end California markets. Down payment rates are highest in those metros because larger loan amounts incentive buyers to put down as much as possible to reduce their monthly mortgage payments. Also, buyers in the expensive markets have more money. So metros with the highest growing, the fastest growing were all in California, except for New Haven, Milford, Connecticut, and Springfield, Missouri. Huh. That's interesting. So you have, Thousand Oaks, California, Modesto, Stockton, New Haven, Milford, Connecticut, and Springfield, Missouri. States with the largest down payment percentage growth: New Hampshire, Rhode Island, Connecticut, New Jersey, and Washington. And then they have the top 10 that declined. Interesting. All right, so that's one big reason why there's a big affordability issue, is that whenever people want to purchase a home, not only does it cost more to live where they want to live, but they also have to put more down in order to purchase the property again. I say again, because that's the trend that happened. You remember when everyone was to the market with a bunch of cash, and if you had an FHA loan, like fat chance on getting that accepted. That is not where we are right now. I feel like all these reports are a couple of months behind, and where we are living right now is a market in which if you have an FHA buyer, then you could actually do really well for them right now in this market. And so I feel like there's a change happening right now versus what the news is telling us from the last couple of months. And so I'm anxious to see how that plays out and what's really going on, which is one of the reasons why I like the show and you guys chiming in and saying what it's like in your area. Are you seeing an increase in investor purchases? We are. We're seeing more investors that are interested in properties. It seems like every time buyers pull back, investors kind of push forward. They're like, okay, well, we'll take a look at it. So we are seeing an increase in our investor inquiries. What's it called? I'm a Bigger Pockets agent. I don't know if it's a preferred agent or something like that. And we're getting a lot more calls from them. Adam Johnson said, people should really be looking at 5-year armed products, no interest rate down. People are mostly going to refi 5 years. It's a no-brainer for almost everyone. Olivier said, Con. Adam said, I've had a few buyers with grandparents and parents write them mortgages for houses. Yeah. People have to put more money down so they can afford the payment or even qualify with them for the payment. We talked about the Nepo home buyer that was using family money and what percentage. I want to say it was something like 15% of people were using family money. Adam said, I'm looking for your response and thoughts on the 5-year ARM product. That's why I keep bringing it up. Well, I mean, I pretty much leave the financial counseling to the lender. I think it is right for some people, but I would still say there's danger in it. Risk reward, right? So it is a higher risk product because if rates don't go down and they continue to go up, and let's say it comes time to refi, but you're in a position where rates are at some kind of stupid 15% number and you can't even get approved for the refi, you're in trouble. And so I think for some buyers, it's appropriate. I think setting aside a lot of money to take care of it in the future if it does happen, where you can't refi and you need to pay a big chunk into it to get a different loan deal or something. If you can't do that, then there's a big problem. And I don't think it may be for you, but lenders are talking to them to buy down a rate, which doesn't make sense either if they're going to refi in 3 to 4 years. Yeah, I think the best thing, one of the things that we've suggested our clients talk to the lender about is the free or extremely discounted refi if they refi within 2 to 3 years. And so if they purchase a property now, buy one that you don't have to refi in order to afford the property, but get the bank, lender, or whatever to commit somewhere in writing for you that if you were to refi in 2 to 3 to however many years you can negotiate, that it's going to be free or extremely discounted. And that seems to satisfy a lot of folks because if they're thinking about getting an ARM, but they're going to refi anyway, then this is also another option for them. But it's still not a guarantee. It's not guaranteed that the rates will go down. It's not guaranteed that you're going to get a better deal. And so my first advice is don't buy a house that you can't afford a monthly payment on. That's number one. But then number two, if you do something like an ARM, if you do something like, a rate buy down, you got to do the math and you got to know what you're doing. Don't just sign up for a 5-year ARM because it has a lower rate. Understand the consequences and what happens at the end of the ARM. Because you may hit a great time to refi or you may not. And you just got to understand the risk. Adam says none of the ones I see have balloons. Yeah, yes, you're correct. Balloon mortgages are definitely different, but still, you have to be able to refi at a lower rate than what the ARM is, or what you currently have, or you're not really saving much money. Armando says, what's up, Armando? Armando sells Houston. Armando, realtor in Houston, Texas. If you need any help here, the market has been hot. And he says he loves my background. Thanks, Armando. Armando is where we got the, what kind of show is this? Sounder. I can't, which I all the sounds on my soundboard. So I got to put that one back on there. I don't know where it went. Sorry. I did a special DJ thing for a group, and I changed them all, and then when I put them back, it didn't go. All right, so investor purchases. That's what we were talking about. Investor purchases for the first time in nearly 2 years. This is a chart and report from Redfin. So the national year-over-year growth in investor purchases, it was at its highest 2022, which home prices were also at their highest at that time. And then if you look at the Q1 numbers for 2024, it's just about the 0%, 0.5%. But that is after 6 quarters of decline. So from 6 quarters of decline to now up 0.5%, relatively flat, but we are noticing a tick in investor inquiries. Now for us in 2023, we had a huge increase in investor inquiries. And I think maybe that's because people were getting out of some major markets and asking a lot of questions about the minor markets. And we sold a lot of investment properties during that time. But it has not been the same in this quarter versus then. That's for sure. But we still have investors that we work with and make them a bunch of money. It's just fewer initial inquiries. The gain was primarily driven by an increase in purchases of single family homes. Let's see, investor activity in the housing market stabilized following several years of dramatic ups and downs. Investor purchases more than doubled during the pandy. Investors are making more money than before. Investors are reaping bigger profits than they were a year ago. The typical home sold by an investor in March went for 55.2% more, $174,616, than the investor bought it for. That's up from 46.3% a year earlier, and just 5.3% of homes sold by investors sold for a loss. So that's down 13.7%. So that's pretty good numbers. You buy, what is that? You buy 20 houses, you lose on one. Armando, don't have. All right, so here's the chart for that one, the National Investor Purchases chart. We're at 43,916 currently in Q1 of 2024, which matches, what's that match? Back in 2016. Matches the number back in 2016. It also matches us coming back up from the dip in 2020 range. So, yeah, well, they're still not what they were, but they're going up. National investor market share. So this is interesting. Investors are buying up the biggest chunk of U.S. homes in almost 2 years, while investors are purchasing fewer homes than they were before during the pandy. Result of today's relatively slow market, they're still purchasing a fairly high share of homes. So as a percentage, they bought 18.7% of U.S. homes sold in the first quarter. That's up from 17.9% a year earlier, and the highest percentage increase in almost 2 years. So yeah, the investor share continues to go up from 2000. It's just going up, up, and up, and up. A lot of people got feels about that. But they're also adding a lot of inventory to the marketplace because there's many buildings that would not be built unless the investors were investing in them. So one day those homes will probably come back on the market. They'll sell them. And when that happens, there'll be a huge increase in inventory. I think that's all the that's all the good charts. Then it's just got the areas where it breaks it down by metro. So for more information on that, check out Redfin. Interestingly, kind of I guess, adjacent to the report for investors, demand for vacation home mortgages fell 40% in 2023 as housing costs rose to a record high. Sean, Minor Realtor on Instagram says, I wonder if these are buy and hold flips. I think that's why you see a steady increase in the number of percentage of homes owned. I think you see that, but the build to rent market is bigger than ever before. So I think you're also seeing a huge increase in the number of homes built to rent, and the build to rent industry is bigger than ever before because they are not finding where they need as a resale home because people are staying in their homes at a 2% rate, right? So more people are waiting on those rates to go down before listing their properties. So an investor who invest in real estate, what are they going to do? They got to find creative ways to find the inventory, and build to rent is huge in a lot of areas. I think that's what you're seeing. But demand for vacation homes fell. Vacation home mortgages, I should say, fell 40% in 2023 as housing costs rose to a record high. So demand for second homes dropped to a 6-year low in 2023, the number of U.S. mortgage originations for second homes by year. And I think this was due to the gigantic increase in the Airbnb, short-term rental boom. And then when people could work from anywhere, if you were at a company that said, okay, guys, you don't have to come into the office anymore, you can work from anywhere. I think a lot of people went, what? I can work from anywhere. I'm going to work from the beach. Or what? I can work from anywhere. I'm going to work from the mountain. And they bought a primary home in a traditional second home area, and they lived there and they worked there. We are seeing some of those folks being called back to work. Many are refusing and saying, no, I'm going to stay here and just find something to do here. While a lot of them are either selling the properties and going back, or renting those properties out as short-term rentals. That means we're seeing an increase in the short-term rental inventory, which Airbnb says is a great thing for the short-term rental industry. However, if you purchased a home hoping that you would get a pretty steady short-term rental rate, and you did the math on that, you may need to adjust your maths down a little due to the increase in competition for the short-term rental. So it would not surprise me if we saw some folks who bought Airbnbs and thinking, man, I'm going to be able to short-term rental this thing like crazy, and they're just not getting the numbers they wanted, and they're going to put it back on the market. That would be crazy to me. As a matter of fact, in an area where we go on vacation, we were looking at some homes there to possibly purchase some. And right now it's a kind of a cash flow. So if I bought it, it would basically cash flow, pay for itself. And that's not bad. That's good. But there's not like a ton of money to be made in it because of the increase in the prices. However, I was talking with the property manager in the area, and they said what was funny is during the pandy and during the craze where everyone was buying whatever vacation homes they could find, they saw a huge increase in properties that weren't traditionally considered vacation homes selling, and people would remodel them and put them out as a short-term rental. And they were getting some traction because people were for short-term rentals. If you remember, there was a lot of people kind of restricted on travel, and they didn't want to go and stay in a hotel with a bunch of people. So they wanted their own house. And it was a big boom for the short-term rental market. And those homes were doing okay, even though they weren't like the most desirable property on the island or in the area. Well, now those homes are starting to come back on the market. And the reason is because those short-term rentals are not filling up like they once were. She also said that more and more people are waiting longer to rent. And she said used to, they would be booked out 4 months to 3 months to 5 months in advance. And now they're available even a month in advance in some locations. And so then they're finally booking about a month out instead of the pre-planning that we were doing pre-pandy. So there's a lot of changes and transitions in the second home market, short-term rental market, and it'll be interesting to see how it all shakes out through the short-term rental income and through the people that were just living there, that wanted to live there, that are now being called back to work. How many of them will agree to do that? How many of them will agree to go versus finding something to do where they currently are? And so that's one of the reasons why we're looking, is because we want to take advantage of the down. And if we can find something good in the down when people are moving out or when stuff's not running like it once was, then we'll get our dream vacation home for a lot cheaper than we were a couple of years ago. Home purchases fell across the board last year due to low inventory, high mortgage rates, and high home prices. It was the least affordable year on record. Affordability hasn't improved in 2024. It's more expensive to buy a second home. Typical second home is worth $475,000 in 2023 versus $375,000 for a primary home. Additionally, the federal government increased loan fees for second homes in 2022. That was kind of them. Vacation homes aren't vacation homes necessity the way primary homes are. So when housing costs skyrocket, prospective second home buyers back off. Purchasing a second home of your own to use is less attractive portion as it was a few years ago. Purchasing a second home to rent is also a less attractive proposition than it once was because the rental market has cooled as the pandy peak, and owners of short-term rentals on sites like Airbnb are generally earning less revenue. So there you go. Maybe I could have written the article. Second homes are most common in Florida. That seems, yeah. It's less expensive real estate in California. It's still curious about how that will be impacted by the insurance stuff that Florida's going through, though. So that's it. That's all I've got. That's all I've got on the news today. So thanks everybody for joining. It was a lot of fun. Glad you guys are here. Matt, Olivier, Scap, Hillary, all hanging out in the clubhouse with Armando. He's down there. What's up, Armando? And Jan. Man, Jan, I did not see your hand. Hang on. I just said you could come up, Jan. Tony, what's up, buddy?
I didn't see his hand either. Sorry about that, Jan.
That's okay. Jan, I invited you up, but I don't know how to. I can't do it any more than that. So feel free to come up if you're still there, Jan.
On a production note, will you get in trouble if you use sound effects? Because I'd really like to bring those back, and I can improvise those if you'd like.
No, if you, yeah, I would love for you to do the Curb Your Enthusiasm song. Could you do that for me real quick? Here, let me bring this down.
I got to get my trombone out. Hold on 1 second.
Jan, hey man, I see you. What's up?
Hey there, how's it going, Ray? It's great to be here. I feel like Clubhouse Mojo is back.
Yay! Yeah, good. I'm glad you're here, man. What's up, Carrie? Sorry, I'm saying hi to also people on Instagram that are still hanging with the show. Carrie, am I going to see you next week in Banff? Anyway, what's up, Jan? What? I'm sorry, I missed your hand, man. I didn't see that you had something to jump in. So go ahead and jump in. What'd you want to chat about?
Oh, thanks, man. I appreciate that. I just wanted to share my 2 cents on the new NAR intake. And I wanted to also check with you to see, and everybody else, how they are feeling about it. But what I'm seeing with my buyers is we are getting that broker's representation agreement signed, and it's just a very simple task. It's just an extra paperwork, and I'm attaching it to the buyers to the seller's compensation form, where we would ask for the sellers to pay. If they don't pay, then the buyers pay. So it turned out to be just a technicality, and I just wanted to see how everybody else is it.
I agree, man. I mean, that's exactly what's happening here too. It's just a technicality, and one that, we've been filling out that same document for years. So it's just, I don't know what's gonna happen with it, man. What are you guys in Clubhouse experiencing? Are you using any kind of additional forms? We have one additional form that says the same thing that our contracts do, but because we're part of a national brokerage, they want us to use that form as well. We're like, well, it kind of says the same thing. Actually, the first thing they sent us, we were like, we can't use that. Our contracts are worded a little bit different and they're better. And so our brokerage changed it slightly, but it's still like kind of saying the same thing that our contracts say. So what are your guys' experience, Matt, Armando?
Yeah, here in Georgia, we always do like a 6-month update to our contract. So I think it was yesterday on our sales meeting, we talked a little bit about the 3 changes that are coming. In Georgia, it was a law already, if you didn't know that. So
There you go.
So now there's just some additional verbiage that they're adding, but it's nothing radically different. I think it's just some clarifying language for
Interesting.
For some people. So
Yeah, it's not a big change for us here. Armando, is it a big change for you or no?
As far as the NAR stuff,
Uh-huh.
we haven't got any new documentation yet. So,
Okay.
but I'm really heavy on the presentation, as I've always been, but a little bit more honed in on presenting everything. And then as far as the changes, I had buyers actually thinking that I guess whenever the old date was going to go in effect, I think June or July.
Yeah.
That they had a window, thinking, oh well, we have until, this was like a month ago, till we can have your compensation covered. I said, no, you don't. Like, it's always been negotiable. Like, they're like, we need to buy in the next 2 months before this change is happening. I said, yeah, we need to talk about that.
Good for you.
Like,
good. I good for you. Instead of saying, yeah, we better get on. Cause you could have gone the other direction. And said, oh yeah, you have to buy. Let's go. Who else do you know? Let's do this.
I was going to say, we did have a seller come through that was like, we're going to wait because when this all changes in July, then we won't have to pay buyer's brokerage. And I was like, well, so not exactly what's going on here, but good for you.
The misinformation out there is huge.
And as a matter of fact, I have a couple sellers who are planning to go live around August, and they already agreed to pay full commission to the buyers when it comes to it. So we won't just put it on the MLS, but if they can ask for it, they're going to designate the commission for the buyer's agent.
Yeah. I mean, that's kind of what's happening here too. Like, I did have one conversation with a client that said, they just asked, they were like, still have to pay buyer agent compensation. And I said, no. And they said, oh, really? I said, yeah, you've never had to. And they said, what? I said, I know. Isn't that crazy? You've never had to. And they're like, well, what's the purpose of the lawsuit? I said, I know. Isn't that crazy? So I said, yeah, you've never had to in Arkansas. It's always been. And then I kind of told him how it works. How much do you want to put out there? And then of course they turn it down on me and say, well, how much do you suggest? I'm like, well, I mean, here are some numbers that you see in our marketplace, but it's totally up to you. You can put as much or as little as you want down. And they generally wind up going the same numbers we used to have on there, which I'm being intentionally vague on purpose, but they generally wind up going with the same numbers that we all used to use. So, and I think that's the most interesting part, where it proves that those numbers weren't what was falsely negotiated, but it appears that is what maybe the market bears. I do think so. The one way that this possibly adds savings. Well, wait. Jennifer Mabry says, not a big change in Portland. Most agents here feel that sellers won't have a problem with the buyer agent commission, buyer agent compensation. The one way that it would save people money is if you have a real estate agent that says, I'm going to work for you for 1%. And the seller has offered compensation of, I'm just throwing numbers out there, 3%. Appears that would save them now 2%. But there's still some discussion in a lot of contracts. It says that, the real estate agent, the real estate brokerage gets the money and then they pay out. So in those situations, would the real estate agent keep the other two? It kind of depends on how all that shakes out. The weird part for me is going to be the rebates. So let's say you want to use an agent who offers a rebate. They're essentially going to have to fill out a piece of paper for you that says, I'm going to charge you, and again, I'm just making up random numbers. I'm going to charge you 4% and I'm going to read you 3%. Well, or you could just not charge them. like the rebate thing is going to go away, I think, because it's very difficult to negotiate with a buyer. No, can't you see I'm giving you money back when you're signing a document for them that like, here's how much you're responsible to pay, and it has that figure in there. Like, hey, I'll give you $200 back if you'll give me $300. Well, why not just keep your 200? Like, so I think that's going to be really rough for the what is it called? The rebate companies, I guess, the discount companies that do the rebates. That's going to be very difficult for them to move forward with that scheme. Armando, are you still there?
I am. Mm-hmm.
What kind of show is this?
I got it back while we were talking. I found it.
Now I can follow you back.
Yeah, follow me back on Instagram. That's still one of the best clips. Thanks, Matt Malarsh, for clipping that for me. All right, any more discussion on the? Donna's laughing. Any more discussion? Jill, what's up? I didn't see you there. Ashley, she's in the house. Some folks I don't know. Hey, guys. All right. If there's no more discussion, I guess I'll just end the show. So thanks for all the chatter. That's why we do this thing, man. It's a very different show because you guys have input in it. And I just bring you the news. I want you guys to take on it. Tell the people what's really happening. So that's what kind of show this is, Armando. So thanks everybody for joining us. I really appreciate your participation. We have a goal, 10,000 subs on YouTube. So if you haven't subscribed on YouTube, please go to YouTube, subscribe, but only subscribe if you're going to like check out the show. Don't subscribe if every time you see my face, you're going to scroll. Don't do that. So check out the show there. This podcast will be released this afternoon in about an hour and a half, 2 hours. It'll be loaded so you guys can download the podcast version as well. If you're an audio listener and you've made it this on the podcast, please take a second and rate that podcast. That'd be awesome. All right, everybody. Thank you. I will see you next time. Actually, I'll have to do a special show next week from Canada.